The Kansas City housing market is crashing in reverse. And while buying a home got a little bit easier, especially if you're thinking about doing it before the end of 2024, it will not last forever. In this video, we're breaking down 3 different topics, starting with 1, mortgage rates and how they've hit the lowest level in over 4 months. Number 2 is the Kansas City housing shortage, and not just the national reasons, not just because of inflation and lack of supply, but 2 reasons that are very specific to the Kansas City area. And number 3, why the Kansas City housing market is more likely to crash in reverse as opposed to seeing massive price drops. Part number 1 is mortgage rates, and according to this article from Yahoo Finance, mortgage rates have now fallen to the lowest level since mid-March. We scroll down a little bit, we can see exactly where they were sometime in early May, 7.22%. Of course, we've covered this extensively on the channel in past real estate market update videos. We've seen anything between like a 7.1 to 7.3, and it's kind of going back and forth. It's nice to see that as of today, we've got something around a 6.77%, which I know those are small percentage point changes, but that can amount to hundreds of dollars every single month on a mortgage payment, especially when housing affordability has largely skyrocketed because of this large upstick in mortgage rates. Now, if we take a couple steps back, a 6.77% rate just seems high because we had like the 2 and 3% during COVID. Most of the country is at a 5% rate or below. So even though this seems high right now, if you zoom out over a couple decades, this is actually pretty standard for mortgage rates and a pretty healthy rate to be at. Now, if we scroll down at the bottom of this article, you can see they say the downward trend in mortgage rates is likely to continue as Federal Reserve rate cut could be in sight. Market observers are assuming the first rate cut of the year could be in September as the economy shows signs of cooling. We should expect to see both buyers and more sellers enter the market. Could see a market that's closer to balance than it has been in a few years. Now that might be true in a couple markets, like Texas has a lot of price cuts. Florida has a lot of price cuts. California has a lot of price cuts. Here in Kansas City might be a different story, and that's what we'll get into in the second and third parts of this video. First thing that I want to say is if you're holding your breath for even further downward movement on mortgage rates, it's likely not going to happen. That's quite a gamble to make. It's more likely than not that mortgage rates will not see a more meaningful movement downwards until later at the end of this year. Of course, every single government report about unemployment, inflation certainly causes some fluctuation in those mortgage rates, which is why we've seen them bouncing back and forth between like a 7.1, a 7.3, and of course, right now a 6.77. Now, according to this article from CNBC, we've got a couple different charts about the housing market. Of course, you can see the 30-year fixed, it just skyrockets over the last couple of years because of inflation. But the real one that's important to know is this one right here. And this shows you all of the mortgages for homeowners across the country. Where are they mostly at? And it shows that almost 70% of mortgage holders as of right now are 3 points or more below that standard rate, somewhere around the upper 6s. And of course, if we dial this in even more, you've got a 14%, you've got another 8% that are at least 1 to 2, if not 3 points below that mark. Now, what we're getting at here is that this is a double-edged sword. The lower mortgage rates go, the more demand people will have for housing, but there are a lot of people who are just not going to sell. We also have a massive housing supply shortage, which is why you might save some money in the meantime, like maybe between now and maybe spring of 2025. But the lower mortgage rates go, the more competition there's going to be, the more demand there's going to be, and home prices are going to quickly increase. Now, real quick, if we haven't met yet, then welcome to the channel. My name is Nick Massa. I'm a licensed real estate agent here in Kansas and Missouri. We do these market updates every other week. I know the market's constantly changing, and if you're looking for a home to buy, build, or sell in Kansas City, I invite you to subscribe to the channel so you can use all of this info, make sure you get a much better deal or much better price on your home. Of course, if you'd like to have any specific conversations about how all of this impacts you, feel free to reach out. All my contact information is right below this video. Give me a phone call, text message, email. I'd love to set you up for success. Now, aside from the national factors behind the housing shortage, like we haven't been building enough homes since 2008, the high interest rates, builders don't want to build because it's more expensive, a lot of people don't want to sell their home. Aside from all of those factors, there are 2 that are local here in Kansas City that are accelerating our housing shortage and really causing that unbalanced market, which is why it's so expensive to buy a home. First one is the number of homes being built. A lot of this is due to local politics. Now, according to this article from Fox 4 Kansas City, they say the Mid-America Regional Council reports this metropolitan area is short by as many as 24,000 housing units because of big shortfalls in new builds. Now, the Mid-America Regional Council, they've been in the news recently recently. There's some politics behind that. I don't really have an opinion one way or another, but whether that number is 24,000 units or 50,000 units or 10,000 units, we have such an unbalanced market that every additional home being built impacts that balance of supply and demand. So whether you're interested in new construction or you're interested in an older home, this certainly matters and can impact the cost in either of those markets. Now, this article goes on to cite Will Reuter, who's the executive vice president with the Home Builders Association here in Kansas City. He says that changes to construction codes in Kansas City, Missouri have pushed developers into leaving the show me state for Kansas side suburbs. Now, the backstory on this, there's a lot of politics behind this one as well. At the end of 2023, the government of Kansas City, Missouri updated their energy codes. It's some of the strictest in the entire Kansas City metro area. And the reason they did that is I'm hearing that they got quite a bit of money from the federal government. Of course, we've seen pushes across the country to ban gas stoves and regulate our day-to-day lives. And this seems to be part of that effort. Now, some people might agree that some of these energy codes are good and they create good standards and protect the environment. But the real problem here is that it's increased the cost to build a home by anywhere between $50,000 to $30,000. The standards for each home being built are completely different, and the city has no idea how to actually regulate these, which is why permits are being approved at snail's pace. I've got a client building there right now. It's taken 3 or 4 months and we still don't have a permit. So this is quite an issue. Not only is it more expensive to build a home, but the rate of permits being approved has slowed to less than a trickle, which is not good news, especially for one city in the entire Kansas City metro area that had more new homes built last year than any other city in the metro. So that's the backstory. Now, this goes on to say that one proposed Kansas City, Missouri ordinance intends to help the matter. Rogers points to changes to the Kansas City Municipal Energy Code from 2021 as being a potential deterrent to developers. It certainly is. If I'm a builder and I'm trying to make money, well, I can't do that if I'm not getting permits approved, and it's increasing the cost to build by $20,000 to $30,000. Now there is one side of the equation that says, well, the homes are more energy efficient and you'll save more money over the long run. Well, that's going to take you about 10 to 15 years to even break even, if you break even. And that's with inflated dollars after the fact. So it's really not a good deal for the consumer, and almost looks like the government of Kansas City, Missouri sold out its own population in exchange for federal funding. Now, this goes on to say that the changes from 2021 were meant to make new homes ready for electric vehicles and roofs to be ready for solar panels. Two things that are very polarizing, and we're not necessarily going to get into the specifics in this video. This goes on to say, even with this proposal, Kansas City's energy code would remain the toughest of its kind in the metro. So what this looks like to me is they've imposed this very strict energy code. It stopped the amount of homes being built. We're already in a housing shortage. Each additional home being built can impact the balance of supply and demand. And now we're trying to backwalk a couple of these things. But the problem is they've already accepted money from the federal government. So can they do that in the first place while complying with those regulations? Now, that's just one factor accelerating the housing shortage in Kansas City. Here's the second factor, and this is good for the time being, but over time, the balance might flip. Now, this article is actually from the Kansas City Business Journal. It says, even with rising prices, Kansas City's housing market is not overvalued. Here's why. It says Kansas City's median sales price is about 10% below buying power, which takes into account changes in income in the metro. According to First American's analysis, the median sales price in Kansas City metro was $293,000. The area's buying power is somewhere around $324,000. Compared to the 50 biggest metros nationwide, that gap is the 23rd most undervalued on a percentage basis. Now, a couple downstream effects of this. One, we've got a lot of people relocating to the Kansas City area. You're going to get more value for your money. Luckily, I've had the pleasure of working with quite a few of you. The second one is we've got a lot of investors entering the market. We've got a lot of out-of-state money, got a lot of institutional money. If you're looking for a home anywhere below $300,000 in the Kansas City metro area, there are a ton of those homes that have been flipped over the past year that are long-term rentals that are not in great condition. And most of the time, when you go to look at those homes, the seller's disclosure, sellers likely never even moved into the house. So this is becoming quite an issue where even though we're undervalued right now, could that change in the future? Now, this article goes on to say that researchers at Redfin noted that homeowners are staying in their homes twice as long as they did back in 2006. When the median homeowner spent 6.5 years in one place, says Americans who already own homes benefit from the rising values can consider themselves lucky they broke into the housing market while they could still afford it. So this kind of leads us to that cliche advice, which is the best time to buy a home was yesterday. The next best time is today, because we know the prices are just going to keep going up and up and up. And that's what brings us to the third part of the video, the reverse housing market crash. here in Kansas City. And this article from Bankrate does a great job of summarizing why that's more likely than an actual decline of home prices. It's titled, "Is the housing market going to crash? Here's what the experts are saying." And we're actually just going to scroll all the way to the bottom of this article because they sum this up very, very nicely. 5 reasons there will not be a housing market crash. One is that inventories are too low. That's exactly what we talked about in the previous part of the video. Here in Kansas City, we are at 2 months supply of housing. What that means is if no new homes are listed on the market, we would sell out of all homes in about 2 months. A balanced market is about 6 months supply. So we are 4 months short. Of course, anything more than 6 months would be a buyer's market. We are in a deep seller's market here in Kansas City. Number 2 is that builders aren't building quickly enough to meet demand. This is a big problem in the aftermath of 2008. We had that massive shock to the housing market. Of course, a lot of builders a little gun shy about building more homes because housing prices plummeted. A lot of builders went out of business. And of course, right now today, we've got those other factors, high construction loan rates, right? It's like 9% plus interest rates for builders to go out and build a home. That increases the price of those homes when they do go to sell them. A lot of the builders in Kansas City have stopped building as many spec homes, which is why if you're looking for a move-in ready new construction home, it can be a little hard to come by. And of course, we also have that building codes update. Those are happening across the country. While there is an impact here in Kansas City, Missouri is one place where there's a lot of land north of the river where a lot of homes can be built. That's quite an issue. And there's still a lot of work to be done for the city of Kansas City, Missouri to figure out how to approve those permits a whole lot quicker. There's not a whole lot of guidance that's being given to the builders. This article says number 3, demographic trends are creating new buyers. You've got young millennials, you've got Gen Z who are hitting their peak home buying years. You've got baby boomers who are aging and oftentimes downsizing. A lot of the times they're going after the same exact homes, except baby boomers, they've got a lot of assets. Gen Z, young millennials, they oftentimes don't have as many assets. So you've got this clash of generations happening, and in the backdrop of all of that, you've got the greatest wealth transfer in history. I think it's something like $70 trillion is changing hands from generations over the next 10 years or so, which will massively shake up the housing market. Number 4 is that lending standards remained very strict. It is harder to get approved for a loan today, massively harder than it was in 2008. Of course, that was the main issue, is that in 2008, you had those introductory low interest rate periods. People were approved to buy like 5 or 6 houses. They couldn't even afford one house at a standard mortgage rate back then. And that's a massive backstop to the same type of decline that we saw precipitating in 2007 and 2008. And then it goes on to say that number 5, foreclosure activity is muted. There are so many people sitting on a lot of equity, right? We talked about in part number 1 of the video, people are holding on to their homes a little bit longer. And of course, the longer you hold an asset, typically the more money you make, the more you sell it, the more frequently you sell an asset, the more money you lose. So what we're seeing here is that a lot of people are cashing out on their equity, or they're just sitting on their equity, allowing it to multiply. We know that home prices are going to keep going up, hence the reverse housing market crash of 2024 and beyond. Now that'll do it for this video. If you have any questions or you'd like to have a conversation about how all of this impacts you, how you can use it to make sure you get the right home at the right price or sell your home at the right price, make sure to reach out. All my contact information is down below. Give me a phone call, text message, email. Love to have a conversation and set you up for success, whether you're buying, building, or selling a home here in Kansas City. With that said, hit the subscribe button to see future market updates. And before you go, click either right here to see the most recent real estate market update, or click up here to see the video YouTube thinks you would enjoy the most. So click either here or here, and I'll see you on the other side.